Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JBG SMITH Properties quarterly report. JBG SMITH provides a range of businesses and services through its mixed-use properties in Washington, D.C.'s metropolitan area. The company's portfolio includes multi-family housing, office spaces, retail assets, development opportunities for mixed-use projects. Primarily multi-family units, placemaking initiatives to cultivate vibrant neighborhoods, public infrastructure improvements. These businesses and services are concentrated in amenity-rich submarkets, such as National Landing, which is anchored by key demand drivers like Amazon's headquarters and Virginia Tech's Innovation Campus. The significant increase in JBG SMITH Properties' stock price over the past year can be attributed to several key developments. The acquisition of Tyson's Dulles Plaza and approval for National Landing office-to-residential conversions demonstrate the company's strategic approach to adapting to market trends, transforming obsolete space into desirable residential units. Additionally, a Q2 2025 earnings beat further boosted investor confidence, contributing to an 11.64% increase in stock price on the day of announcement. These factors collectively contributed to JBG SMITH's strong performance within the realty sector, outpacing the S&P 500's gain and reflecting sustained positive sentiment towards the company's strategic direction. The primary drivers of revenue growth or decline for the company can be summarized into several key areas. On the growth side, significant contributors include the acquisition of new properties such as Tyson's Dulles Plaza and the consolidation of 1,100 and 117th Street, which added $12.4 million in revenue. Additionally, higher rents across the portfolio and the continued lease-up of existing properties contributed to revenue growth. The sale of West End 25 also generated a significant gain on sale of real estate. On the decline side, disposals of properties resulted in a loss of $22 million, while decreases in third-party real estate services revenue and losses on sales of certain properties further impacted revenue. Impairment losses related to specific properties also contributed to the decline. These factors highlight the importance of strategic acquisitions, effective property management, and prudent financial decisions in driving revenue growth or mitigating declines. Net income and profit margins. A decline in performance. The financial performance of the company has experienced a decline in both net income and profit margins over the past year. For the 3 months ended September 30, 2025, the net loss increased from $3,226,000 to $6,457,000 compared to the same period in 2024. This trend continued for the 9 months ended September 30, 2025, with a net loss of $18,375,000, up from $5,093,000 in 2024. Profit margins also suffered a decline. The operating income margin decreased from 9.8% to 6% for the 3 months ended December 31, 2024 and September 30, 2025, respectively. However, there was an increase in operating income margin from 23.1% to 29.6% for the 9 months ended September 30, 2024 and 2025, respectively. The reasons behind this decline are attributed to several factors. A decrease in FFO, funds from operations, attributable to common shareholders contributed to a net loss increase of $1.7 million. Additionally, same-store NOI, net operating income, decreased by 6.7% and 5.4% for Q3 and YTD 2025, respectively. Furthermore, the effectiveness of hedging instruments was compromised due to a mismatch between critical terms of the hedging instrument and forecasted transactions. Overall, the company's financial performance has declined significantly over the past year, with net income and profit margins experiencing a downward trend. The company is indeed generating positive operating cash flow, although there was a decline in operating cash flow from $87,190 in 2024 to $40,625 in 2025, it remains a positive figure. This indicates that the company's operations are producing sufficient cash to meet its financial obligations and invest in growth opportunities. The company's debt level has undergone significant changes between 2024 and 2025. While total debt increased from $335,612 to $1,047,381, mortgage loans decreased by $162,000 $564, and revolving credit facility increased by $75,000. However, outstanding debt decreased from $2.6 billion to $2.5 billion. Regarding interest expenses, there are conflicting statements in the provided text. While pages 3, 43, and 49 indicate a decrease of approximately $486,000, or 1.4% in interest expenses, page 47 shows an increase of $8,152 in interest expenses from $97,400 to $105,552 during the first 9 months of 2025 compared to the same period in 2024. Overall, while there are some discrepancies in the data, it appears that the company's debt level has increased significantly, and interest expenses have decreased by approximately $486,000, or 1.4% between 2024 and 2025. Management is optimistic about the company's long-term growth potential, particularly in amenity-rich areas around Washington, D.C. They plan to achieve this through placemaking initiatives that cultivate vibrant neighborhoods throughout the metropolitan area. The company will maintain its REIT status and allocate capital to maximize net asset value per share. Key demand drivers such as Amazon's headquarters and Virginia Tech's Innovation Campus will continue to anchor the business. Management is focused on disposing of underperforming properties, acquiring new ones, and leasing up new spaces. They expect to meet financial needs through a combination of cash flows, borrowing capacity, and other sources, while maintaining quarterly dividend payments at $0.175 per common share. The company has made several strategic acquisitions and divestitures to optimize its portfolio and expand its presence in the market. Acquisitions include capital commitments totaling $114.4 million for WHI Impact Pool, 2020. Initial closing of $43.5 million for Leo Impact Housing Fund leasing corporate offices from an unconsolidated real estate venture with a 20% interest acquisition of the Zoe Valen and office amenity hub at 2011. Crystal Drive divestitures include sale of 3 multifamily assets for $546 million, disposal of 1 development parcel for $100 million, sale of a 40% interest in West Half, a multifamily asset, for $100 million. The company's financial summary reveals that it has indeed engaged in share buybacks. Specifically, it repurchased and retired a total of 83.2 million common shares for $1.6 billion since the program began. Additionally, smaller batches of shares were also bought back during the fourth quarter of 2025. However, regarding dividend payments, the information is less clear-cut. While there are mentions of dividends being declared or paid out in certain periods, it is unclear whether these were regular dividend payments. The company has mentioned paying out $38.1 million as dividends on 2 separate occasions, but this does not necessarily indicate a consistent dividend payment schedule. In summary, the company has bought back shares, but its dividend payment history remains uncertain. Concerns over inventory buildup and supply chain disruption. The company's financial summary highlights concerns over inventory buildup and supply chain disruption. Specifically, a decrease in various fees such as property management, leasing, asset management, and construction management may indicate potential issues with inventory buildup or supply chain disruption. This suggests that the company may be struggling to manage its inventory levels and supply chains effectively, which could have significant implications for its operations and bottom line. That concludes the financial summary for JBG Smith Properties. Feel free to comment below, and I will be happy to answer them when possible.